Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's worked in the investment and portfolio management business since 1992. He founded Profit Plus Capital Management, a registered investment advisor in 2001. And he also manages a safe and secure bullion storage facility in Idaho with, I think, high-level military. It's super high-level military guarding it. Bob Coleman, thank you for joining me again.
Sure, I appreciate it, Jason. Thank you for having me back.
So, Bob, we're recording this interview on Thursday night, November 30th, 2023. The dollar index is at 103.5. It's come down a bit. The managers in the DC at the Fed and the Treasury have knocked it down a little bit when it was threatening to rally. The above 106, the gold and silver prices. We've had a rally here in the gold and silver prices, maybe with the U.S. Treasury yields, the 10-year U.S. Treasury, which we can talk about, and then also the dollar index coming down a little bit. The paper gold and silver prices. I want to get your thoughts, though, on demand for gold and silver. Where do you see the demand drivers right now for metal?
Yeah, it's been somewhat of a eclectic market, I guess you could say, or surprising, I guess would be the word, especially if you're within the precious metals industry. I happened to speak at the Silver Symposium back at the end of September. And what we kind of saw there was this attitude where people were burned out with the high premiums over the last 3 years and have just basically taken a breather from purchasing metals, and at the same time over the last 3 years the metals went nowhere and burned a lot of people out as well, and people got frustrated, and so you had this sort of very negative sentiment going into that low back in the end of September, early October, and I was at the conference then, and I was did some spaces on Twitter and so forth, and publicly been saying that I think what was going to happen was that the metals were going to rally. At the same time, when that rally happens, no one's going to trust the rally. And in fact, what's going to be worse for the industry is that people are not going to buy metals. They're going to actually end up selling metals into that rally, expecting to maybe buy the metals back on the next dip. And that's exactly what's happened. And so what we've seen happen in the industry, especially over the last 2 or 3 months, but it's gotten worse as we gotten closer to the year end, is you've seen a constant wave of selling that's been coming into the market that's sort of offset maybe any purchasing that's been happening, where you get some asset allocation shifts and things like that. And some of the selling is seasonal because you have a lot of IRA distributions and required minimum distributions, things like that. So you'll get that type of environment in October, November, December. But at the same time, you're seeing, talking to dealers out there and so forth, you're seeing people just selling metals, for another investment, for maybe a life event or some type of expense that they may have, or just simply saying, "Listen, I'd rather just throw it into 5.5% yielding T-bills and live off the interest and the income, and not deal with the volatility of the price action of the metals or that type of thing." So you've seen this disenchantment, and as the prices have gone up, it's only created more selling, and that's become a big problem in the dealer community.
So do you expect then bankruptcies and financial problems with some of these bullion dealers similar to what Northwest Territorial Mint or Bullion Direct or Tolving that we've had? Because there's been a lot of bullion dealers, shockingly, that have failed over the last 10 or 15 years.
Definitely, and like the one of the big ones that you may be aware of, First State Depository in Delaware. This is probably the largest U.S. depository failure in U.S. history. They went under last year, and that was basically alleged the owner was siphoning metals, and not necessarily buying metals when people were purchasing them, and not delivering metals, but taking it right out of their box, in segregated storage. And you're talking, I think it's $77 million in losses. I think the CFTC is claiming 112 million in losses, but that's absolutely enormous. And that's turned into a big fiasco. You have, and I kind of report this on my Twitter feed, Profits Plus ID, some of the events that I pick up and I read from the First State Depository receivership webpage. In fact, they're going after. I think they're suing an individual in the Midwest who participated in this silver leasing program in cahoots with the owners of First State Depository. It's just a real mess. And so, but from the standpoint of just typical dealer activity, you've had three just enormous years of profits in the industry, and typically when that usually ends, it usually ends badly because the amount of profits that the industry made off the public was enormous, to say the least.
Are you talking about like the markup, so premiums? So the bullion dealer, did they make a lot of money off the spot price, or it's mostly on the premiums, right?
Oh yeah, the premiums were just enormously marked up. I mean, you had when you're talking Silver Eagles, being sold at $20 over spot, for example, some of the dealers that had that kind of markup, they would be buying from they were authorized distributors for the U.S. Mint, and they were paying $2.95 over spot for that Silver Eagle. I mean, it's that where typically the industry it used to make 25, 50 cents, maybe 75 cents an ounce on silver. You're talking $5, $6, $7 an ounce in terms of profit on a lot of different products. I mean, just an obscene amount of money. And now those premiums have crashed. The bids that the dealers are offering to buy back at are, in a lot of cases, discounts to spot. So now the clients that maybe bought silver at $25, but they paid a 30% premium or 40% premium, they literally have to see a 30 or 40% move in the price of silver just to break even. And that's something I've been warning about the last 3 years over and over. Is be very careful about the spread risk when you're buying products. But this is where the on the dealer models, they got kind of comfortable with this idea that okay, people are just going to constantly buy because the government's going to keep printing money and it's a one-way ticket. But what kind of happened was the industry, I think, kind of sliced its own throat by charging too much. Got a little too greedy. People backed off, and now as you're seeing selling coming into the market, and you aren't seeing the buying, a lot of these dealers are sitting on a lot of inventory. In fact, a lot of cases, dealers will use a line of credit, for example, to finance their inventory. So not only are their carrying costs going up because the line of credit interest rate has gone, basically doubled. You also have the hedging that's required. If you're long a lot of inventory, the bank doesn't want you to be basically price sensitive to that. They want to neutralize that price risk. So you'll go in and you'll maybe short futures contracts to offset that. So if the price goes down, their short futures contract will go up in value, whereas their physical inventory will go down in value, and vice versa. So it neutralizes that.
Is this level? Sorry to interrupt you. Is this level of inventory, and you're saying it's large? Is this a normal high level of inventory, or are we at like multi-decade levels of high inventory with your experience on top of the higher interest rates and carrying costs?
Yeah, this has been a feature that's come in very quickly over the last 6 months to the industry. So I would say that a lot of dealers are swimming in inventory at the moment. It's not a question of all-time high levels of inventory, but what you are seeing is that cost of carry and then the cost of maintaining those hedges. You got to remember, as the price goes up on paper, they're going to have margin calls from their futures brokers that says, listen, you shorted the contract at $22 silver. Now it's at 25. You got to cough up more money to maintain that margin. Very similar to just trading stocks, whether on the long or short side. So now what's happening is they're having to cough up money to protect, their hedges. But now they're not offsetting, any cash flow by selling metals to individuals, or I should say net, maybe they are selling some metals, but they're also buying back metals from the customer base that says, listen, I'd rather capitalize at gold at $2,050 an ounce or $2,000 $40 an ounce and silver at 25, I don't think it's going to stay there for long. You're seeing a lot of that wave kind of come into the market, and so that's adding to a lot of capital cost pressure to maintain that high inventory as well as their hedge position.
And we were talking about this before we started recording. We were talking for a long time. It sounds like all with the Fed raising interest rates where they are, there's just tons of distortion. So on the supply side, there's not going to be a lot of new gold supply, not going to be a lot of new copper and silver byproduct supply coming online because of cost of capital for the miners. The juniors aren't getting funding. Very few new mines are going to be coming online. And then look at the supply numbers coming out of Peru, Mexico, and Chile for copper and silver byproduct the last couple of years. I mean, they're all trending enormously downward, and yet here you have what enormous distortions here, it sounds like, from the bullion dealers that have mismanaged because of interest rates and an overcharging on premiums too. So it just sounds like a mess.
It is, and this is the problem when you charge as high as you do in the industry, and you lose the confidence of your consumer. And this is just like with the stock market. Once confidence is lost, it's very difficult to gain that back. And I think, especially with precious metals investors, we all tend to be more frugal and conservative with our money. And if you realize, oh, wait a second, I way overpaid for this product a year or two ago, and there really wasn't a shortage. It was just a bunch of mantra from promoters or from dealers that were pushing product to get me to buy at this really high premium, buying 1 ounce rounds at $6 over spot, which now they're over, when you sell them back, you're going to get discount to spot at this point.
Ouch.
Yeah, it's a real problem that the industry is going to be facing, and then you're going to get the worry of complaints.
I think we need to make some discrepancies here with the sentiment. So the sentiment that you're describing, it's going to be very bearish, very negative from retail investors in the United States and Canada. So and I'm just seeing all these posts on social media like, I'm done with gold and silver. I'm done with gold stocks. I won't buy these things again. I'm just going to buy Bitcoin or stocks or real estate. I'm seeing lots of these posts all over social media the last couple of years. Sentiment is very, very negative for the majority of people. Tons of people that were in gold and silver be like, I'm done with it. I won't buy it again. But the sentiment is the opposite, I would say, when you're looking at investors outside the United States, because the gold price in these other currencies, Bob, whether it's in Japanese yen, Australian dollars, Chinese yuan, they're just soaring compared to the dollar gold price.
Yeah. Now, don't get me wrong. I run a depository, just for full disclosure. I run a hedge fund that invests in physical metals, 99.4% invested in physical metals. I think this is a great setup. And I've been saying that this setup is what's going to catapult gold and silver a lot higher. Especially, I've been saying that since really the lows of back in beginning of October, is that this is the perfect setup. The idea when you look at sentiment readings and you see as low as sentiment got back in October, it couldn't get any worse, so to speak. And so basically a lot of people were washed out. Well, there's only usually one place to go once everyone becomes a seller or becomes distraught, it can only get better from there. And that's typically what you want to watch for when you're managing money or you're trying to watch markets. One tool or indicator is sentiment. And so with that said, you're going to walk up this wall of worry. The bearish sort of sentiment that you see with retail investors isn't going to dictate or overrule what happens with the spot price. The spot price is acting independently of whatever the retail environment is doing at the moment. And what you are seeing here is more of a paper-driven rally in the futures and options markets, driving the price higher, as well as you've had a lot of buying over in India and China. You had it was reported in India they have their festival called Diwali in the fall, and this happened to come in November. It's a little bit later in the year, but in October, the import numbers came in and it was just off the charts. It was a lot of buying, took everyone by surprise, and then you'll also have a lot of buying that's going on in China as well, and that's being very supportive. Whereas, and everyone's scratching their head saying, "Well, God, I'm looking at these ETF flows, and you're seeing an outflow of ETF assets, and you're seeing the retail environment not really in joining in this rally. In fact, they're selling into the rally. But that's what makes the market kind of what it is. It's, when everyone
well, this goes back to demand drivers. So you were talking about retail and sentiment, and those are important here. So it's a disparity between the Western demand. So you said institutional levels with the ETF outflows and Western retail investors in the US and Canada versus the actual demand drivers. I would argue for gold are non-G7 central banks. We were discussing this. So if you're a central bank and you're running a trade surplus or you have foreign exchange reserves, you don't have a lot of options to put capital. So the main areas where central banks normally can allocate capital are either to US treasuries or gold tonnage. Those are two of the main ones. Unless you want to be like a hedge fund like the Swiss National Bank or Norway, one of their sovereign wealth funds, go buy stocks and trade stocks. But the majority of central banks aren't doing that. They're either buying US treasuries or buying gold tonnage.
Yeah, you have to remember too, the central banks also hold a lot of dollar reserves with the anticipation that there's going to be a lot of dollar trade. What if their expectation was that the economies are going to slow down and they don't need as much dollar reserves because they're not going to be needing as much trade going back and forth between their exporters and the importers of each country? So it kind of feeds on itself a little bit, as well as.
Well, also, would you want to loan the U.S. Treasury money for 20 or 30 years? Because it doesn't seem there's demand for the long bond.
Right. Yeah. That and you, I think you hit the nail on the head there. With Yellen basically saying, "Listen, we're over 70% of our financing of the U.S. deficit is going to now be U.S. T-bills." All they're doing is kicking the can down the road because they're really just shifting the balance of power in terms of financing into extremely short-term debt, which right now there's a high demand for because they have this massive slush fund called the reverse repurchase program that's been dialing down as they've been issuing more US T-bill debt. But you also have a lot of retail and institutional investors that says, listen, the 5.5% return, it's very attractive, and I don't have to take all this volatility. I'll just stick it in there. So it's an easier sell to the public. The problem is those rates can go up and down very quickly over time, and that will play havoc on the budget deficits, especially the interest expense and debt servicing of the U.S. government.
Well, we also have a bunch of, I think, 8 trillion of the national debt, and it's over 34 trillion already. It's growing so rapidly. I think it added an extra trillion in a couple of months.
What's a couple trillion between us?
It's just it's never going to get paid back. It's growing at an accelerate. It's a runaway train at this point. The majority of decision makers in DC don't want to cut back. But my main point here is you're talking about how there's demand for these short-term treasuries. Well, the U.S. Treasury has to refinance about $8 trillion of debt in the next 12 to 18 months, has to be refinanced. And the refinancing costs, I think, are going from 2 trillion up to over 4 trillion. So that's a lot of extra interest expense. The 10-year U.S. Treasury, Bob, like we were talking about this before we started recording, it looks, if you look at a 3-month chart of it on the yields, it looks like a meme stock or a penny stock. The yields have gone up and down that much. It went from about 5% on the 10-year U.S. Treasury yield about 2 months ago. It's down to 4.3.
Yeah, totally. And a lot of that had to do with the quarterly refunding announcement. Again, Yellen basically saying, listen, we have to be able to stabilize the economy and create, keep asset prices as high as possible. So basically, let's stop issuing or issue a lot less longer term debt and try to cool the interest rates down. As well as, you got to remember back in July, I think it was, the U.S. Treasury announced they were actually going to start buying back longer term U.S. debt next year, which I don't know with what money. I guess they're going to finance it with short-term paper. That'll end in tears, I guess.
Well, we were talking before we started recording. I think the Fed's official balance sheet, what they're saying, it's down over $1 trillion with quantitative tightening, 95 billion a month. I don't think those are the real numbers. There's a lot of shenanigans going on that they're not going to allow a Fed audit. Let's just put it that way. Another real Fed audit.
Right. Well, it also, not to get too caught up in the weeds, but bank reserves have actually gone up as the Fed's balance sheet has gone down. So that's neutralized that quantitative tightening. You got to remember all that money coming out of the reverse repurchase program buying all those T-bills, for example. Those T-bills go to that cash goes into the Treasury General account. The Treasury General account starts spending that down. That money goes into people's pockets, and that's where the bank reserves float higher, and that provides a lift to the economy. And that's what you call deficit spending.
Well, except that the banks are saying, the loan officers, the CFOs at the banks are saying in the surveys that they want to tighten credit. So I don't know. I'm seeing banking. I'm speaking with bankers here in the U.S., Canada. There's a banking crisis coming. I think it's commercial real estate here in the U.S., but the rest of the loan book for consumer debt is bad for U.S. companies. And outside the United States, I mean, there's a lot of problems with foreign banks, with the dollar where it was, and losses on treasury bonds.
Yeah, I think you're right. My whole idea, the way I look at it's very simple. It's all about collateralization and financialization. So if your loan is based or backed by an asset, and that asset starts losing value, all of a sudden, when you go to refinance that loan, and that bank says, "Listen, your assets was valued at X, now it's only valued at Y. We're only going to give you a loan for this amount, and now you got to come up with a difference." That's where the rubber meets the road.
I wonder, maybe the Federal Reserve Bank will create a new shadow liquidity program, something similar to the BTFP or something like that, not counted on its balance sheet. They'll change all the roles and extend it. They'll loan at par, similar to the 2019 repo crisis, which is the BTFP. Was created. So I think they'll have to create something like that. The commercial real estate, Bob, there's a ton of office buildings. I don't know what the banks are going to do with them. I don't think they want to be commercial real estate property managers for thousands of office buildings.
Well, it's not just commercial real estate. I mean, you're seeing all this excess residential real estate that was bought, second, third type homes that turned out to be really homes that were for our Airbnb type of activities, like rents and things like that, and people that had basically put on their FHA mortgages that they were actually going to live there. It turns out that they actually their intent was really to rent it out, and now you have all these municipalities like New York and other big cities that says, "Listen, we're now going to regulate this industry," and says we're only going to give out so many licenses a year to allow so many houses to be rentable, and because the hotel industry is hurting, and
Well, hotels are better priced now. The whole point of doing Airbnb in the first place initially was it was cheaper than a hotel. So you could rent a room at an Airbnb cheaper than a hotel. But then because of the Federal Reserve Bank policy, right, with zero interest rate policy and QE, you had all those people that said like, oh, I can't earn any interest on all my savings. I'm going to set up a rental property with Airbnb. Now rents are too expensive. And so you don't get the value. Hotel rooms are cheaper now, better value.
Yeah, and you don't have to deal with that extra cleaning fee from Airbnb as well, I guess. So, but yeah, that's part of as the markets ebb and flow, that's where you get too much money coming into one sector, it changes the dynamics, and we're seeing that same type of situation happen in the precious metals. I think the precious metals industry is very similar to the car industry at the moment. You're seeing a glut of inventory. You're seeing prices starting to come down on new and used cars. So it's happening with other retailers as well.
And let me add, because I didn't mention the exact numbers. You were talking about the spike in Indian gold imports and silver imports. The numbers are enormous. They're up for gold imports 95% year over year for gold imports out of India. This is private sector, not their central bank. And then for Indian silver imports, private sector up 120% year over year. That's insane. That's a big increase.
Yeah, and you saw a lot of that flow actually come out of London. I think it was like 34 million ounces or so of silver and 4 million ounces of gold or something like that come out of London. So that's what we're seeing in the industry. And I've been saying a lot of this the last couple of years is that since Basel III was implemented back in 2021, I believe it was. Is that, or 2022? I'm sorry. Is that the gold and silver have been going to what they call off exchange type facilities or counterparties, and leaving the traditional exchange based type of program. So like you see the COMEX, for example, in New York. The futures market there, the volumes, the open interest are way down. from 2020. And I think you're seeing that outflow from London as well, where basically people are saying, it's the old adage with retail investors in the U.S. If you don't own it, or if you don't hold it, you don't own it. Well, it's a very similar situation with foreign countries and central banks in those countries that basically says, listen, we'd rather hold the metals in our own country than, for example, at the Fed in New York.
The trend, though, for gold is enormous central bank buying over the last, 12 to 18 months. Poland, the Chinese central bank, People's Bank of China, 12 months in a row, purchase increases, Singapore, Brazil. The purchases are all the net purchases. They're not from the G7. They're from non-G7 central banks deciding we don't want to buy a lot of U.S. treasuries. We want to diversify into gold tonnage then.
Yeah, and again, some of that, like you mentioned, could have been from the scare when, with what happened with Russia, where the Fed just says, or the Treasury says, "Listen, we're going to cut you off. Your reserves aren't really your reserves," and it could also be the fact that there's concern that ultimately the U.S. is going to have to inflate away its debt. And also inflate its currency to maintain either asset levels or some type of economic.
Just to fund the government, man. We were talking about the tax receipt. If the stock market is low, if home prices crash and the stock market stays low for 6 months or more, I think the Fed has to reverse. The Fed has to go in there and fund state and local governments, like they bought municipal bonds in 2020. They have to fund the federal government. I don't see the government cutting back. Here in DC, both parties, they both want to spend more. It's nuts.
Yes, yeah, and from what you told me with regard to the parties, it seems like it's in everybody's interest just to keep the game going, and not stop it.
Well, look at the debt ceiling. I mean, the debt ceiling stuff. The real reason the last Speaker of the House was fired, the uncapped on the latest debt ceiling agreement. It seems like we're going through these debt ceiling agreements at a faster pace now, and the national debt's growing at a fast. It's just insane.
Yeah, and that's, you typically see this as you get into that, that a lot of people look at, Weimar Republic, that exponential type part of the curve when it starts to just go vertical. You see the same thing happening with our flows and our debt creation in the US. And that's the scary part, is that, when you look at high inflation or hyperinflation, that is not an economic event. Hyperinflation is an emotionally driven event where people lose confidence in the currency, and that can happen. It doesn't typically happen during good times. It actually happens when unemployment is very high. In fact, typically you tend to see 20 and 30% unemployment rates when you see hyperinflation. So that's
also the other part of hyperinflation. If you go back over the last 120, 130 years, it's normally politically driven. And a lot of the hyperinflations are from like an emerging market or a country that has like war reparations debt in a foreign currency. So the emerging markets that have had hyperinflations, normally the debt is in a foreign currency, like a dollar denominated debt, and they can't print it. They can't pay back the loans in their own currency.
Right, but the U.S. has an interesting play on it, being it's the world reserve currency. You're right; it has a buffer there, but you have to remember we're also negative. Foreigners own a lot more of our assets than we own of their assets. I think it's like, what was it, 8 or 12 trillion dollars or something like that of that foreigners own more of our debt than we own of theirs, or of assets. So they could actually start selling assets here in the U.S. and really just unloading and getting out of the dollars completely, and that would actually be highly inflationary, but also crippling asset prices as well at the same time.
Well, I think foreigners actually, because like on a relative basis, the U.S. still has more economic opportunities and more freedom, and there's faster inflation in a lot of other countries. Like look at Argentina for many years. I am cautiously optimistic Milei will improve things in Argentina over time in stages if he's allowed to stay there for a number of years. But I mean, Argentina for the last like 15, 20 years, it's just been a basket case. So a lot of people have wanted to come to the United States. So I think there are people who still want to buy like homes in the United States at the right price, or stocks here in the US at the right price. I don't know if they want to sell, but well, I think they want to sell treasuries. I don't think there's foreign demand for U.S. at maybe the short term, but I think it's really risky. Bob, you've been in regular finance, managing money, hedge fund too, besides just gold and silver. It's really risky. I'm just hearing this now. everyone's like, oh, I'm just buying short-term treasuries. Even Warren Buffett, 29 billion short-term treasuries. Everyone short-term treasuries. It just means like, well, if there's a demand now, the exit liquidity 6 months from now, there's not going to be exit liquidity.
Well, if you, with U.S. Treasuries like T-bills, for example, the exit liquidity is just the maturity, and then your expectation is that the government's going to pay you your money. Yeah, that's basically the exit strategy behind that. But I think the concern is that the election coming up next year is going to create uncertainty. It's going to create maybe some artificial stimulation in the economy or in asset prices. But it's really, I think more people are starting to become very nervous going into 2025, 2026 of really something dark coming down where it's going to be, it's almost like a mean reversion from all this sort of partying and sort of sugar high that the markets are on now, that potentially you may see that recession finally come and it may be a lot worse than people expect.
Or there is no official recession because all the government economic data is cooked, like the jobs reports. So they announce the jobs report numbers, and then a month later, they just cut in half by 50%. Or the majority of the jobs that were created, they're all part-time jobs where people are working multiple part-time jobs, or the largest industry that hired was the government. Or you have the case where a couple days ago on Monday, Bob, did you see the article from Bloomberg? They actually extensively, I was shocked that they did this. They actually disproved all the consumer price index data with an extensive article showing all the cost increases over the last 2, 3, 4 years. We're all up 20, 30, 40%. And the consumer price, the new number that just came out, the PCE number, saying inflation is basically at zero.
Yeah. Oh, the statistics that are, it's definitely a lot of massaging manipulation. I mean, there's, I think the CPI uses a 5-year forward average as well as a 5-year backward average modeling, and then that you won't know actually the real numbers until 2 years from now anyway. So it's all sort of it's a big guess, and it's a shame that the markets are so tied to whatever that number that comes
I wouldn't
out.
even call it a guess, Bob. I would call it they're intentionally fooling these algorithms so that like they put good headlines for the jobs numbers to fool the algorithms, and the algorithms. Wall Street wants low inflation. They want inflation coming down. They don't want the inflation too high, and then they want the jobs reports up. And then like no one talks about the revisions later.
Right. It's they want the Goldilocks economy.
As we wrap up here, it definitely sounds like the demand for the demand drivers for silver are going to be industrial demand because governments are going to want to sponsor silver. We're seeing that with the reports for Silver Institute and demands coming from outside Western countries, like outside the US and Canada. But where are the best deals you would say for our listeners out there? Because a lot of people still want to, they're contrarian, they still want a dollar cost average and buy bullion. Where do you think people should be looking for the best deals for bullion and premiums right now?
Yeah, and we're still seeing people buying. It's not that everyone has just walked away from the market. But basically on our website, goldsilvervault.com, we have a pricing page. We've been buying and selling metals since 2009. We deal with the wholesalers. So price wise, there's not a lot of markup, and you can see our premiums right on our webpage. Just go to, I think it's pricing or buy metals. There's a tab there, and that way you can kind of compare and shop. I would definitely tell the consumer out there, definitely try to shop around. Don't trust one company. A lot of people did that the last 3 years because they developed a relationship of watching someone on YouTube or listening to them in social media, and then just basically thinking, okay, they're the place to go to. But a lot of times they ended up overpaying for the metals. So definitely shop around in this environment, or feel free to check us out.
Now, did you say that you have like an app that compares the premiums and the bullion prices for the different dealers? Because you mentioned YouTube and stuff. There's like larger financial YouTube channels than me out there, and they're getting, I don't know if they're disclosing this properly, they're getting paid like pretty fat commissions to promote bullion from a certain company.
Oh, definitely. No question about it. It's been a big, there's been absolutely very little transparency in terms of absolute commissions and compensation that's being provided. and how much the customer is actually paying, not only to the dealer but also to the salesman, as well as to the promoter or social influencer. So and that's something that's been, I think that whole system is sort of unraveling here because these premiums are coming down. And I think the public, before the pricing power was really to the dealer side, now the pricing power is becoming more to the consumer. And I think that's where the shift is taking place. And that's where I think a lot of these dealers are going to feel a lot of pressure going into the new year.
Are people going to get better deals overall buying like 10-ounce bars or larger bars, or buying rounds rather than buying like some of the sovereign coins?
Yeah, there's definitely some deals out there. Yeah, before the last 3 years, it
Yeah,
was so.
the markups on silver eagles are normally pretty nuts.
Yeah. Ours is like for storage, we're $3.95 over spot. For drop ship, it's $4.05 over spot. By far, I don't know anyone who's beat our prices over the last 3 years. We tend to be, half of what any of these major online retailers charge. But that's the loyalty that we have to our customer base. Again, we also run one of the largest private depositories in the country. We store about 700 million in assets. So we're a very big player when it comes to not only the purchasing and selling of metals, but also storage as well as logistical support, because we actually do get involved with. We have armored trucks. We deal with armored logistics and that type of thing as well.
And for the listeners out there, if you're new to Bullion, the Eagles, the American Silver Eagles, they look beautiful, but in general, you're paying sky high premiums for them. So to try to find good premiums on the Eagles, like sometimes the markups on them are absolutely insane. If you just want metal, the Eagles are normally not the best place to go.
Yeah, they tend to be the most expensive. And just to be completely honest, again, right from the U.S. Mint to its distributor, the U.S. Mint charges $2.95 per coin right out of the gate. So that's one of the reasons why the prices are typically higher. But we have 1 ounce silver rounds, $1.70 over spot. So you can certainly get other types of products out there now. Whereas maybe the last 3 years, a lot of dealers were selling 1 ounce rounds at $6 over spot. We were selling,
Wait,
sovereign.
rounds? Regular
Yeah,
rounds, not
yeah,
Eagles?
yeah. It was terrible. I mean, it was $5-6 over spot, and we were selling sovereign product for like $3.50 over spot. So like Britannias and Philharmonics. So it was a way to try to help clients get into the market where they could overcome that spread as well. Using the metals as an investment, not necessarily as a collectible or retail object, and that's part of the problem I think that a lot of people got frustrated with, was that they ended up realizing how much they overpaid for this product, and what they were told was happening in the market wasn't actually so.
Are there websites you use that actually track like the different bullion dealers online and like a trend of the premiums? Because kind of like I've interviewed a bunch of gold and silver experts and bullion dealers, and they always try to track the trend of the premiums. And so they say the best time as a contrarian for value investing to accumulate more metal is when the premiums are in a downtrend and sentiment is negative. But I didn't know if there's any websites that actually track like a collective group of the bullion dealers where like premiums are down 50% or something like that.
There's not that per se, but there is a website. It's called findbullionprices.com. Just findbullionprices.com, all one word. And that's like an aggregator site. So it tries to take pricing from multiple different dealers out there. That may give people sort of a shortcut rather than going from dealer to dealer. You definitely could look at that. I don't think they track us at all. But that's one site that you could use just from an aggregator standpoint.
So would you expect then that over the next couple years, the bullion prices are probably going to have to trend higher? Because I don't see on the supply side, I mean, I cover mining stocks, royalty companies. The funding is just not there. I mean, juniors are going away. They're selling out the companies to larger miners for pennies on the dollar. Most of them can't raise any funds whatsoever. Very few new mines are going to be brought online. So yes, in the short term, I think overall, Bob, you highlighted that there are inventory problems with the bullion dealers, but the bigger picture here, there's severe supply side problems for copper miners, for governments that want like electric vehicles and green energy projects and rebuilding their electrical grid. And there's just not enough investment then into new copper and gold and silver mines.
Definitely, and you got to remember, silver. I think peak production happened 2016 or mid 2000 teens. So since then, you haven't seen an increase in real production. And part of the problem is the silver price hasn't gone up, and it hasn't provided any incentive whatsoever to start another mine. And a lot of times,
silver. Sorry to interrupt you. Silver is also a byproduct, so you need a higher copper price or some of these other base metal prices. But then you have the banks, and the banks don't want to give the miners money either, because a lot of these banks or institutional investors, they have like ESG bylaws, and they don't want to fund mines.
Yeah, you're absolutely right. 70% of what silver's production, it comes from byproducts of other mining. But you have to also look at energy inputs, labor inputs, cost of equipment inputs. All that has gone up. I mean, we all talk about protecting ourselves from inflation, but the problem is the mining community is experiencing inflation firsthand. And that becomes their higher cost of production that eats their bottom line very quickly.
And grades are collapsing. I mean, I did a study on this for patrons over 12 months ago on Pan American Silver. Their average ore grades have been cut in half in under a decade. So the industry is just dealing with higher input costs, like you said. The cost of capital is up now with the Fed rate hikes, and everything's priced off the 10-year treasury. So cost of capital's up, labor costs are up. And then on top of that, the grades are falling. So their profit margins are a mess. I just see this as there's not going to be $10 an ounce silver available in the next 5 to 7 years. I mean, the price floors are going to be much higher.
Yeah, I mean, if you look at the primary silver producers, I think there's been work done that says that their cost of production is between $21 and $23 an ounce. And at that point, that's you need that price just to break even. So there's an incentive.
So no new mines then. Yeah, no new mines.
Yeah, exactly. And that's a problem, especially when you just saw what happened with Newmont mine down in Mexico over the summer. They had this, the one of the largest silver mines in the world. Actually, the whole company went on strike down there at that mine, costing the mine $6 million a day. The labor market feels the pain along with everybody else. So they're like, well, we need more money to pull this stuff out of the ground. I mean, there's a lot of different variables running a mine, and that's one of the reasons why I kind of prefer the physical metal, because I think over time, I think the markets are going to move much higher. Silver will move much higher. And I think ultimately, in a typical bull market, what drives the bull market eventually is buyers do come into the market and do start to move that price higher, not wanting to miss out. And that's ultimately what drives that frenzy when it reaches its plateau or high. But I think that's what we're seeing. We're seeing this mistrust in the market right now, this wall of worry that's being built, that and obviously with the metals, there's a story that's going to be told, but it typically doesn't get told until the metal prices are a lot higher, and then you see, oh, okay, that's why it went higher. The metals tend to disguise itself very well.
Well, also the sentiment is just very negative. You look at the earnings reports for the largest and safest gold stock, which is a precious metal royalty and streaming company like Franco-Nevada. I mean, they crushed earnings that just came out in the last month or so for Q3, and yet the share price is down near a 52-week low. I mean, the share price is off, I think, 30%, but their earnings, like the underlying business, they don't have to worry about all those costs that are going up. Like you just said, for the miners, their profit margins, Franco-Nevada, are insane. So they're minting money right now, but the market is in risk off mode. It wants short-term treasuries. It's not interested in gold stocks or growth. And yet you have like Franco-Nevada, the earnings reports are very different than the share price.
Yeah. Yeah, and that's where, again, people need to kind of do their own due diligence, do the research, selecting these stocks and like you said, royalty companies.
Well, they're minting money, so I don't know what's going to happen to the share price in the short term, but I mean, like the earnings reports are really great.
Yeah, I think some of this was part of that Panama situation. There was concern about the strike down there and that sort of, I guess, resentment toward the mining community. I think Franco Nevada had a property down there.
Their guidance is down a little bit, but it doesn't justify a 30% drop. I mean, like their the spot price of gold didn't drop 30%, their profit margins didn't drop 30%, their guidance didn't drop 30%. So I think it's like from a contrarian value standpoint here. I mean, this is the cheapest I think Franco Nevada's been in 3 years. So it's looking like a good time to accumulate shares to me. But yeah, I for a diversified portfolio, I think like buying physical metal and looking not overpaying for premiums is really smart. And then as a value investor, I'm looking for good businesses. So for the royalty and streaming companies or non-ESG energy plays, commodities are a good inflation hedge.
Yeah, and I think the way I kind of put it very simply is that mining stocks and securities are timing the market versus metals are time in the market. Because really the physical metal investor is really a long-term type of investor that's buying this for not necessarily a quick play, so to speak, but really they're buying it for whether it may be for retirement protection or insurance type of insurance protection against the falling currency, or potentially for an estate, and eventually as a estate plan where they can basically gift the metals to their beneficiaries, something that will hold its value over time. That's sort of the advantage, or the sort of the allure of the precious metals.
And your company stores the physical gold and silver in a secure area, because we were talking before we started recording, unfortunately, and I've read this just sad story. Shockingly, there's a lot of friends and family members that find out that someone has a lot of bullion, and there's just been tons of thefts. So your company offers some additional diversification and safety there.
Yeah, what we do is, again, being a registered investment advisor, I looked at this market back in 2005 and 6, and it's very unregulated. It is sort of like the Wild West. You do have to do your due diligence, really talk to whoever you're looking at using as a program or structured program to buy metals through or store metals with. Understand the differences between allocated storage and segregated storage, and unallocated or pooled storage. There are huge differences within the industry of all these types of operations. And so what I did was I said to myself, if you're going to do something right, you got to do it yourself, because I didn't see any program back then that met all my risk parameters and risk analysis. So what we did was we opened up a depository. It's the only depository in the country that's not owned by a gold dealer, financial institution, or like a cash in transit type company, like an armored car company. So it's purely an independent facility that's its main interest is the client's best interest. The metals, the buying and selling is a secondary part of my business that's not tied to the depository, and that's where I don't need my business model is much different than the industry. Whereas the industry, the gold dealer typically owns the depository to sort of capture the transaction. Here, my job on the depository side is to protect the client's metal first. If there's a transaction that's needed, I can certainly do that, but I'm not charging the type of markups that the typical dealer would charge. So it really is a model that's really that's wrapped around the client's best interest.
And maybe talk about the security, the level of security, because at Gold Switzerland, what they have at James Bond, it's in a mountain vault, and it's like crazy level of storage, like in kind of a James Bond movie or a spy movie, buried deep in the mountain. But your security is a little bit different, right?
Yeah, we use, it's the type of stuff that we use. It's not the stuff you buy at Dick's Sporting Goods. It's certainly it's a lot of hard. We do a lot of training with very prominent people within the industry in terms of the ex-military industry and so forth. We have a lot of respect for them. It's the gear we use. We're also a federal firearms license dealer, so we also can sell some of the products that we actually use to protect ourselves with, which helps high net worth individuals say, listen, this is a world that's very unfamiliar with me, but can you guide me on not only protecting my wealth, but how do I protect myself? And I think that's where that's the way we look at it as a facility and a family run business. In fact, it's one of the reasons why when you have family working for you, you're one of the things that makes it kind of neat for the customer is that I'm protecting, not just their assets, but also my family as well. And we're tied to the hip with the client. So we've never had a loss at the facility since we've been in business since 2008. It's just we're fully insured by Lloyd's of London. It's a wonderful atmosphere, but again, you have to be very transparent as you can with the customer, so they can make an informed decision. But at the same time, we love what we do.
And there's probably a minimum. And if our listeners want more information on that, they should go to your website.
Yeah, definitely. We have a lot of information there, and they could also, our phone numbers on there, so they could call in. They could certainly talk to me or anyone at our team here. But yeah, definitely goldsilvervault.com, all one word. But yeah, it's definitely for people looking to buy metals as well as to store them. Just understand that the nuances. I've done podcasts. There's podcasts and articles on our website about how to select a storage facility, what to look for, what questions to ask. There's certainly a lot of information out there that I try to put out, and I'll also take the time to talk with each person to really educate them, on what may be best for them. Also, what to look out for.
Yeah, unfortunately, in the gold bullion dealer at the retail level and also a lot of these storage facilities, there's just a ton of red flags. I've seen, shockingly, so many bullion dealers overcharge people, rip people off, screw them over, buying back metal, overcharging on premiums. I've seen the bankruptcies, shockingly, from a lot of these bullion dealers that I thought were super successful. And then a couple months in a bear market, they go bankrupt, and then you just see these articles about some of the storage facilities, and there's problems too.
Oh, definitely. And the CFTC is really cracking down. The Commodities Futures Trading Commission is really cracking down now on a lot of these dealers, these physical dealers that have preyed on the elderly or really charged extremely high commission rates. A lot of state attorney generals are going after these companies. And of course, you see a lot of these companies, now that the run is over, a lot of these guys have left the country. The damage has been done. A lot of people have lost a lot of money, and it's a shame because the precious metals are known as honest money, but there's a lot of dishonest people that work, unfortunately, in this industry, and the problem is people don't know until something does happen.
Well, to add to examples there, I won't name the company, but I had a signed advertising contract with one of them, and they told me after that contract was signed to basically go pound sand and fuck myself. So, I mean, it's unfortunate, but I mean, I have firsthand examples, and I've heard from other friends too who've gotten screwed over with overpaying for premiums. And then I think there was another bullion storage scam in Alabama a number of years ago too. I think it was tens of millions of dollars.
Yeah, there's a lot of them out there. You had, and you typically have, it's like watching the ocean tide. When the tide goes back out, you finally see what everyone's wearing. Well, when prices start to go down or activity starts to diminish, you tend to see who's over levered in the industry or maybe making the wrong decisions, playing the market from the wrong side. And those are the ones that get hurt initially. But the problem in our industry is that tends to leave a black mark, as well as sometimes these counterparties have these second tier effects on other dealers or other counterparties in the industry.
So it sounds like these higher interest rates and the premiums coming down is going to unearth a bear market, potentially bankruptcies and criminal charges in the not too distant future.
Yeah, and we're seeing that already. But yeah, it's unfortunate, but this is just like any other industry out there. You see it with other types of retail or industrial activities, things like that. When you have a group or an industry take advantage of a consumer base or a business base for a period of time, and then all of a sudden that dries up. You tend to see the disruption that follows. This is going to be no different.
Well, yeah, look at the Fed raising interest rates and keeping them at these levels. And then you have the short bear market in the altcoins and crypto that expose the fraud at FTX. And I think you're going to see all these problems come out about commercial real estate and the other stuff, and the junk bond fraud and some of the other stuff that's been going on with Wall Street, if the Fed doesn't lower interest rates.
Yeah, and that's the trap. I mean, we've all been accustomed to lower interest rates, over the last 15 years since 2008's crisis. And the question is, can they keep rates low? I don't think they can, because ultimately that's going to stoke inflation again, because there's just been too much money created. And then that's going to create its own problems down the road. But that's why we're buying precious metals, because the idea is that down the road, we don't know what the value. The dollar is the release valve for all this mess. If you can lower the value of the dollar, you basically inflate away the debts. That's usually the path of least resistance. And as a precious metals investor, or an investor looking for some type of insurance or protection against that type of an event, especially with political uncertainty or government uncertainty, when the public loses its confidence, the metals, that's usually when the metals really take off. It's typically not during consumer inflation. It's really more about the increase in uncertainty.
Yeah, or I'm looking at sentiment. So, especially because I studied the mining sector a lot for gold and silver miners, I'm looking at mining costs. So, if the bullion price, the spot prices go way below the mining cost, or substantially below the mining cost, say like 10, 15, 20%, I know it's not going to stay there for that long, because I think even more mining supply is going to come offline. Back in 2015, I mean, I was getting emails and phone calls that all the gold and silver miners were all going to go bankrupt. So, that was probably a good time to buy back then.
Yeah, and we saw the same thing that happened last year in 2022, when you had a lot of paper selling, and all of a sudden you had this massive backwardation, meaning the futures price was actually cheaper than the spot price, and that was basically because of the massive physical demand that was coming from Asia. And other parts of the world back in the summer and fall of 2022. So yeah, you're right. There's equalizers that happen in the marketplace that tend to say, okay, once prices get too extreme to one side, it'll start to bounce and go the opposite direction. I think we just saw that happen in the beginning of October. You saw sentiment levels that measured where you typically see real bottoms in the market, 2018, 2020, when you saw those lows come in, you were seeing very similar sentiment measures in October or late September. So those are the things that you try to watch for as an investor for any asset out there. Metals are no different than the stock market. You just try to watch, use your different tools that you're comfortable with, whether it's sentiment or charts or stochastics or all that type of stuff. It's a guide.
The other correlation I've kind of noticed, Bob, in the last 12 to 18 months, and this correlation doesn't always hold, but it seems it's been pretty evident lately, the last like 18, 24 months, is the oil prices versus gold prices. So if the oil price is just ripping higher, the gold and silver prices were kind of bottom trading range, or kind of in a bear market going down temporarily. But it seems that now the oil price has cooled off, and now gold and silver are starting to firm up in the bid. So I don't know if that correlation will hold, but it seems that correlation is working for now.
Yeah, and some of that is just the nature of the markets, momentum trading, CTAs, commodity trading advisors trading the futures markets. You tend to see these moves of momentum, and people pile in whatever's working, they pile in, whatever's not working, they'll try to short down. And sometimes the markets get caught in that malaise as well. So it just depends. It used to be that if oil was going up and gold was going down, the economy must be doing well. And then gold going up and oil going down is basically a recessionary type of indicator, with the idea that uncertainty is coming forward, and we may have demand destruction in oil and all that kind of stuff. But yet the world changes, and obviously when they've created as much money as they have, that money is like water swishing around in a bathtub. It's just moving from side to side, and affecting asset prices.
Well, also for the commodities in the real world, and a lot of commodities like oil are used up and not recycled. And it's even expensive recycling metal, because like you have to pull the metal out of like scrap yards, and you have to use a lot of energy. We're just in a new normal now. I mean, the cost of production for all these commodities, it's not going to be heading lower over a long-term trend. I just don't see it.
And what's the interesting part with silver is that it's the same price it was back in 1979, which is kind of hard to find another price of something else that was back then in 1979, a commodity that's priced similar. So yeah, that's the frustration with silver, is that it's greatly underperformed, and that's one of the reasons why I think, because of its cost of production or cost of mining, it's
Well, there was a ton. Let me add to there that so that is a very valid point that the silver price has underperformed the consumer price index, the government inflation rate for so long. But I would argue that there was a ton of silver supply that came online too from all the byproduct with all the copper and base metal mines. So I just don't see a lot of new copper mines coming online. There was a ton of copper mines that came online with silver byproduct because of Chinese growth over the last like couple decades. I'm not sure we're gonna see a lot of new copper mines coming online.
Yeah, and then also the demand, the industrial demand for silver has been picking up, obviously with solar panels and automobile, smart technology going into automobiles. These are all things that are supportive longer term for silver.
Yeah, I completely agree. And look, I'm non-ESG energy, but the governments want to fund this stuff. So the governments are in control of capital allocation for government spending budgets for wind, solar, biofuels projects. I don't have a lot of say in the matter. So I could just criticize when they're doing bailouts for like Siemens Germany for wind and solar, or the government, like some of these government energy companies, these green energy companies that got government funding. 2 years later, the share price went from a penny stock to $5, and then it crashed and went bankrupt afterwards. And the insiders at the Department of Energy and the lobbyists and stuff like that, and the DNC family members all cashed out.
Yes, and that's why we buy metals, because it's very frustrating watching the political process.
Well, I'm right here firsthand, and I can tell you that no one, all the key decision makers in DC, none of them are actually talking about cutting spending. I mean, what the newest debt ceiling agreement, it's uncapped.
Yes, yeah, it's a very frustrating environment, especially for conservative investors and citizens, like ourselves, that trying to make sense of something that doesn't make sense. And I think that's what drives a lot of people toward maybe the metals as something that says, listen, this has been around for 5,000 years. It's stood the test of time. This is one asset I can trust, that it's going to outlive me.
Well, also, let me just say that debt-based fiat currencies are a Ponzi scheme, but it's not just the US government doing it. It's all these governments are all printing. Like they printed over the last, what, from 2020 to 2022, all of them printed many trillions.
Definitely. And it's one of the reasons why I say this is not a US centric event anymore. This is a global event. And that's one of the reasons why the precious metals are kind of an interesting asset class, because it's something that everybody has in common.
Exactly. And that's why people in China, the demand for private sector in China and India, because these governments are also printing. They're probably, Chinese government has a housing bubble that's collapsing, their banking system problems, and their economy is not stable right now with loss of jobs and stagflation, I would say. And it looks like there's going to be bailouts for their banks or their governments with the problems with real estate prices falling. So the Chinese people are buying physical gold and silver. There's a little break recently, but the demand overall is still up a lot over the last couple of years. And then the demand driver looks like non G7 central banks and private sector demand in China and India.
Definitely. And then also you have, I guess, this new virus or pneumonia going around.
Well, I don't know what the governments will do to financially to do with that, but I'm not in favor of lockdowns and any more draconian policy. So we'll see if what they decide to print or bailouts to big pharma or something, give them an unbid contract.
Sure.
It's just absolutely ridiculous at this point.
I hear you.
Well, I want to thank you so much for your time today. I really appreciate it, and I'll put links to your websites for my listeners in the information and description section.
I appreciate it. Thank you, Jason, for having me.